Subscribe to my channel so you don't miss the next steps toward financial freedom. Let's rewind for a second. To understand how we're getting played today, we have to look at the tools they handed us. Back in 1924, the Massachusetts Investment Trust launched the very first mutual fund. It was revolutionary. The idea is you give your money to a smart guy in a suit. He picks the winners, and you settle up at the end of the day based on the fund's net asset value. It was slow, steady, and expensive. Fast forward almost 70 years to 1993. We get the very first US ETF, the SPY. Suddenly, you could trade a basket of stocks instantly, just like a single share. So we have mutual funds, the old guard, often active, and ETFs, the flexible new guard. And then there's the index fund, which is just a boring, beautiful strategy that says, I'm not going to pick winners, I'm just going to buy the whole haystack. But here's where the trap snaps shut. For decades, we've been pitched this idea. Pay us high fees, and our experts will beat the market for you. It sounds logical, right? You pay a doctor to fix your health, you pay a mechanic to fix your car. You should pay a fund manager to beat the S&P 500. But the math is lying to you. According to the S&P Dow Jones SPIVA report, which is basically the report card Wall Street hates, over a 15-year period, roughly 85 to 90% of those high-fee actively managed funds underperform their benchmark. Let that sink in. You are paying premium prices for subprime performance. And it gets worse. There is a dirty little secret in the industry called closet indexing. Here's how it works. A manager is terrified of underperforming and getting fired, so they charge you huge active management fees, but then they secretly just construct a portfolio that looks almost exactly like the index. They are hugging the benchmark to save their careers, effectively guaranteeing that you pay for a Ferrari but drive off the lot in a Honda Civic. You take all the risk, pay all the fees, and get none of the alpha. So, if the experts can't win, how do you win? The answer is actually hiding in plain sight. In the last block, we established that paying a Wall Street expert to pick stocks is statistically a losing game. But let's get specific about why it's losing. It comes down to three things: cost, taxes, and timing. Let's start with cost, because this is the compounding killer. Every mutual fund has an expense ratio, the yearly fee they skim off your total investment, whether they win or lose. The typical actively managed fund charges you anywhere from 0.75% up to 2% every single year. That sounds tiny, right? It's not. Imagine you start with $100,000. The difference between a fund charging you 1.5% versus a passive index ETF charging you 0.05% is devastating. Compounded over 30 years, assuming a modest 7% return, that tiny difference in fees can steal over $300,000 of your potential returns. That's a down payment on a house, gone, just because you chose the wrong percentage. Fees don't just reduce your return, they compound your loss. Next up is taxes, and this one is crucial for US investors, so listen closely. When you own an active mutual fund in a regular brokerage account, the fund manager has to buy and sell stocks constantly. When they sell winners, they generate capital gains. By law, they have to distribute those gains to you every year. That means you get hit with a tax bill, the dreaded phantom capital gains. Ultimately, most investors can actually achieve better long-term results by simply indexing, only to the fantastic use and a quick close. ETFs, on the other hand, use a sophisticated trick called in-kind creation and redemption. I won't bore you with the mechanics, but the result is magic. They largely avoid distributing those capital gains. This makes ETFs vastly more tax efficient for your taxable accounts. It's not just a difference in fees, it's a difference in how much you give to Uncle Sam. Finally, timing and liquidity. Remember how we said mutual funds only trade once a day at the closing price? Well, an ETF trades all day long, just like a stock. This allows for total flexibility. You can set limit orders, you can react instantly to news, and yes, you can even short them if you think the market's heading down. The liquidity is phenomenal. The SPY ETF is often the most heavily traded security in the world. Mutual funds are slow, one-shot deals. ETFs are dynamic, high-speed tools. We've covered the structural failure of active funds and the massive financial drag of fees and taxes. Now it's time to name names and look at the simple, three-fund solution pioneered by the ultimate rebel of finance, We've seen the hard truth. Active funds cost too much, punish you with taxes, and fail to beat the market 90% of the time. You are trying to chase the 1% of managers who might win this year. Stop chasing. The antidote to this underperformance is not some hot new crypto or a meme stock. It is radical simplicity. It's indexing. And you don't have to take my word for it. Listen to the Oracle of Omaha, Warren Buffett. Buffett has famously said that most individual investors should simply put their money into a low-cost S&P 500 index fund. Why? Because he proved it. In 2014, Buffett made a $1 million bet that the S&P 500 would crush a sophisticated basket of actively managed hedge funds over 10 years. He won that bet handily. He put his money where his mouth is, and that's the ultimate verdict on Wall Street's active management strategy. If the greatest investor of our time says this is the winning path for you, you listen. So, what specifically should you buy instead of their high-fee traps? The goal is to find the cheapest way to own the entire market. Look for broad market index products, something tracking the total stock market, the S&P 500, or a total international index. I'm talking about expense ratios near zero. Think 0.03 or 0.05%. Names like VTI for the US market or IVV for the S&P 500. Some brokers, like Fidelity, offer funds like F0ROX with zero expense ratios. Yes, zero. You get the same market return for free. The secret, the alpha, is simplicity and patience. John Bogle, the founder of Vanguard and the father of the index fund, summed it up perfectly. He said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Meaning, ignore the daily noise, ignore the guru shouting about the next hot stock. Over the long haul, the market weighs the true value of all those companies, and a low-cost index fund ensures you capture almost all of that growth. The ultimate showdown is over. ETFs and index funds win on cost, they win on tax efficiency, and they win on consistency. But the journey isn't just about buying the right thing, it's what you do next. Subscribe to my channel so you don't miss the next steps toward financial freedom.